So I made a video a couple of months back called Stocks for Beginners, and in that video we discussed how the two main ways that investors make money on stocks in the stock market is through both capital appreciation, which is effectively just an increase in the share price, but also dividends. And ever since I made that video, I've been thinking about how important it is to have at least some stocks in your portfolio which pay out dividends. Reason being is that if none of the stocks in your portfolio pay out a dividend, well then your returns are going to be largely at the whim of the market. Because remember, your stocks could increase 50, 60, 70% in value, but until you actually go ahead and sell those stocks, those gains will remain unrealized gains and won't represent real cash returns in your investment account. And of course, until you sell the stock, it always has the potential to decrease in value. So having at least some stocks which pay out a dividend can be a nice way to ensure that you're realizing at least some form of return over the period in which you own the stock. So let's have a chat about dividends. How's it going, everyone? My name is Dan, but you can call me Malone, and today we're discussing dividends. Dividends are without a doubt the best part of investing in stocks. There's honestly no better feeling than seeing a big list of quarterly dividends due to be paid into your investment account. But for a lot of people who are new to the stock market and investing, they might not consider whether or not a particular stock pays a dividend. And in my opinion, the dividend status of any investment is a critical consideration which can't be overlooked. So today, what we're going to do is as follows. First, for all my prospective investors out there who are new to the stock market, we're going to quickly catch up on what dividends are and how they work. Secondly, I want to take a look at why exactly dividends are so important for any successful investment strategy. And finally, I'll give you some pointers as to what you should be looking out for when trying to figure out which dividend stocks to invest in. But before we begin, as always, if I could ask you to please leave a like on the video. Liking the video really does help me out a lot as YouTube pushes the video to bigger audiences based on the number of likes that the video gets. And if you are new around here and are interested in weekly educational content which will help you to achieve financial independence, please do consider hitting that red subscribe button below and clicking the bell for video notifications. We make financial education videos on this channel aimed at making conversations like these more of a cultural norm. So without further ado, let's get started. So what exactly are dividends and how do they work? Well, the first thing to consider is that when you go ahead and purchase a stock on the stock market of a particular company, you are in fact becoming an owner of that company. And what this means in reality is that you have an entitlement to the net assets and earnings of the company. And so a dividend is a payment made by the company to its shareholders as a reward for owning shares in the company. These payments are typically made either monthly, quarterly, half yearly, or yearly, and are paid on a per share basis. For example, if a company declares a dividend of 20 cents per share and you own 10 shares in the company, well then you'll receive a dividend payment of €2 as a reward for owning the shares. There are 4 important dates that you need to be aware of when it comes to companies paying dividends. First, there's what's known as the declaration date. This is the date on which the board of directors of the company announces and approves the payment of a dividend. On this date, information such as the value of the dividend, the record date, and the payment date will be announced. We'll discuss what the record date and payment date are in just a moment. The next important date is known as the ex-dividend date. This is the date before which you must purchase a share in the company in order to be entitled to the dividend payment. The ex-dividend date isn't actually set by the company, but rather the stock exchange on which the company trades sets the ex-dividend date based on the record date, which is set by the company. The record date is the date on which the investor must be present on the company's shareholder records in order to receive the dividend payment. Typically, the ex-dividend date is set 1 day before the record date. And finally, the payment date is the date on which the dividend is actually paid to the shareholders. The dividend is normally paid directly into the shareholder's investment account. So let's take a quick example to illustrate those dates in practice. Let's say we own shares in Company X. The board of directors of Company X announced on the 11th of October that a dividend of 20 cents per share will be paid on the 16th of December to shareholders on the company's records as at the 30th of November. So in this case, the 11th of October is our declaration date. The ex-dividend date is set 1 day before the record date, meaning that the ex-dividend date in this case will be November 29th. This is the day before which you must purchase shares in Company X in order to be entitled to the dividend payment. Bear in mind that the record date in this case is November 30th. And finally, the payment date of the dividend will be on the 16th of December. So having discussed dividends and how they work, let's now take a look at why dividends are so important for any successful investing strategy. You might think that when you invest in a dividend stock, you logically just take the dividend that you're paid and use the cash in your day-to-day life. But in reality, what most investors investors should be looking to do is to reinvest the dividend right back into the stock which paid it, or another stock which the investor is interested in. The reason why you'd want to do this is to benefit from what's known as compound interest. Compound interest is fundamental to any investing strategy which seeks to build lasting wealth over a long period of time. In fact, Albert Einstein once said that compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. Compound interest in the context of dividends can be achieved by reinvesting the dividends that you receive right back into another dividend yielding investment, so that now your dividends are earning you dividends. The power of this technique is best explained by using an example. Let's say we decide to put €200 per month into an investment for a period of 40 years. We'll assume that the investment pays a dividend of 5%. So €200 per month invested over 40 years comes out to approximately €96,000 of our own cash that we've decided to put into this investment. However, because we decided to reinvest the dividends that we received from the investment, our €96,000 has grown to over €289,000 by the end of the period. And as you can see from the graph, not much is happening in the early years in terms of growth, but as time goes on and as we continue to reinvest our dividends, the value of our investment starts to grow exponentially. This is why it's so important to start investing as early as possible, because you want to get the early years out of the way so that your investment can start compounding on itself in a very noticeable way. Now, there are of course caveats to dividend stocks. Generally speaking, dividend stocks won't see the same kind of rapid increase in share price that the likes of growth stocks could see. However, what you potentially lose in price appreciation, you gain in regular realized income. Remember, gains on your shares associated with increases in the share price only becomes real money in your investment account once you actually go ahead and sell the share, which you may or may not want to do. But at the same time, you don't necessarily want to exclude good companies from your portfolio just because they don't pay a dividend. So having a healthy balance of both dividend paying and non-dividend paying stocks is a smart choice for any well-diversified investment portfolio. Now, in reality, it doesn't really make a difference whether your investment return is achieved through dividends or an increase in the share price, just so long as the investment return is achieved. But dividends can ease the mental battle of investing too. There's something comforting about not only receiving a dividend, but also seeing your dividend increase over time. And it provides you with some level of reassurance that the management team of the company are committed to creating and extending shareholder value. Okay, so now I want to provide you with some thoughts as to what you should look out for when choosing a dividend paying stock to invest in. The first thing I'll say is that exchange traded funds, or ETFs, which track the likes of the S&P 500, do have the ability to pay out dividends on a quarterly basis, meaning that you can obtain easy access to diversification while also providing yourself with a regular source of income. Now, with that being said, you will likely be able to obtain higher dividend yields elsewhere by investing directly in individual dividend paying stocks. And just to clarify, dividend yield refers to the dividend that you receive from a stock relative to the price that you pay for it. So for example, if you purchase a stock for €10 and that particular stock pays you a dividend of €1, well then the dividend yield for that stock is 10%. So you might be asking yourself, why don't I just invest in the stocks which pay out the highest dividend yields? Well, companies which have higher dividend yields are oftentimes riskier investments, because if you think about it, for every €1 in dividends that the company pays you, it has €1 less to reinvest in the business. So if companies are paying a dividend which isn't sustainable in the context of its cash flow that it earns from its business operations, well then your returns could actually suffer, because the stock market is going to reflect the poor performance of the business in the share price. So instead of chasing high yield, your best bet is to research companies who have been paying a steady dividend over a long period of time, preferably where the value of that dividend has been growing over time also. The reason why you want to do this is because you're effectively providing yourself with some level of reassurance that the dividend payment that you can expect will be both consistent and sustainable. If you do a quick Google search of dividend kings, you'll be able to see the list of companies included within the S&P 500 who have increased their dividend payment for at least 50 consecutive years, which is an outstanding record of consistency and commitment to shareholder value. My personal favorite dividend king is Federal Realty Investment Trust, which is the only dividend king operating as a REIT. However, there are other household names on the list such as Coca-Cola, Johnson & Johnson and Procter & Gamble. So this would be a great place to start when researching some dividend paying companies to add to your portfolio. So hopefully here at the end of the video you now have a better idea of what dividends are, why they're important, and what you should be looking out for in a good dividend stock. Dividends are just another tool at the disposal of investors for creating sustainable wealth. And when coupled with investments focused towards capital appreciation, they can add a nice element of diversity to your investing strategy. Plus, as I mentioned at the start of the video, seeing that nice list of quarterly dividends due to be paid into your investment account is honestly one of the best parts of investing. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like in the video, subscribe to the channel, and I'll see you in the next one. Cheers.